You're making an important point there, and I don't want it to be lost, because we are in a market that is dictated to a large extent by passive strategies. So the pool of available capital for these companies that you're talking about, sub-billion-dollar IPOs that we might not talk about that often, has shrunk. I mean, how many managers out there are actually paying attention to these people?
Well, more than enough. I mean, I think, obviously, or they wouldn't have gotten done. So there's definitely, if you look at the amount of money in active management, there's never actually been more money in active management because of the valuation and the market value of active management. So even though 50% of the market is sort of passive, the other 50% has increased remarkably. And so these folks have to find growth opportunities in order to outperform their passive brethren. And I would argue that the IPO engine for them is actually one of the greatest ways for them to generate positive alpha over their passive. Because you know who doesn't participate in new issue at all? Passive money. So we've done literally hundreds of IPOs at Cowen. I've never seen an index fund or an ETF at the initial offering. So when the IPO engine works, and this is really critical, you have to make sure that these companies actually perform. Then you get incremental alpha for the active managers. And that's really, at the end of the day, the secret to getting these companies public.
So, Jeff, we got a green light from Powell yesterday on rate cuts. We have this very vibrant IPO market where you have so many names up more than 100%. What does the pipeline look like? Are the floodgates open?
How about the floodgates? I think we did have 6 weeks, by the way, of really basically no activity because we had negative market performance. And so,
the shutdown.
And the shutdown happened earlier this year, for sure. And so I think a lot of the pipeline is clearing. But I will tell you, from what we see, there's a lot of companies behind it. So I'm not seeing a slowdown in backlog at all from our perspective. I think there's a lot of companies that are teed up to access the public markets, and the demand is there from investors as long as those companies are priced correctly. So I actually feel pretty bullish about it.
Would you argue the most recent ones have been priced correctly? Because we keep talking about money being left on tables.
Well, so I think there's a very big bifurcation between big tech and everybody else. I'm not going to comment on big tech. We're not that involved in price setting on those deals. But the companies that we bring, by and large, have continued to perform very positively, and that's kind of what we're all about. I mean, and so there is a very healthy element to the public markets, mostly for sub-billion-dollar market cap companies that help you to the private markets to not get away from you. Right? So if the private market valuations are inflated, the public market investors sometimes just sit on their hands until it gets to a value that they can actually invest in. So I think it's a very healthy dynamic that goes on.
Some of these companies still choose to get acquired as opposed to go public, though.
Yeah, they do.
And there is, I think, a lot of conversation around some of the unicorns out there that perhaps will go that route as opposed to actually taking a chance in the public markets. So
sometimes it's a matter of whether or not you actually have to have capital to execute on your business plan. And so we always say that if you're going to do an IPO and you're going to access capital, that new capital has to be put to something that actually helps the company to grow. But if you've reached a level at which you don't think you can grow much more, selling the company and to another competitor that maybe can take it to a different level or a bigger consolidator is an option. And so when we're talking to companies, oftentimes we're talking about dual path. Should you think about an exit? Should you use the public market or the threat of going public as a way to drive your value in an exit? These are really important conversations. And I always say, like, the best advice is holistic advice. You know, investment banks are famous for giving you the advice, I like to say, that's best for them. I like to go in and sort of talk to companies about how you actually can think about the range of outcomes. Sale the company, financing the company, growth of the company, and then really let the shareholders or the board or management duke it out on which they think the best path is for them.
Finally, Jeff, I mean, we're looking at a market that's at a record high this morning. What are you seeing in terms of client activity, levels of bullishness and positioning around this really vibrant market?
Yeah, so there's a lot of capital sitting around. People were very defensive coming into this rally. Certainly, again, we had 6 negative weeks of performance in equity markets between the end of April and the beginning of June. And there was a lot of volatility where people were just trying to get their heads around the geopolitical situation, the tariff situation. People are digesting that. And I think we have some very clear view from the Fed that we didn't have before around maintaining the expansion. Those were key words yesterday from Chairman Powell, right? Maintaining the expansion, that's new, right? We haven't heard that from the Fed before. And so if you're looking for a signal that it's safe to come outside and redeploy and you're sitting on a ton of cash, well, now would be a time to do it.
But we don't have any clarity on trade.
We don't. We don't, but we also had this massive stimulus coming into trade. And I think people you have to link the two. I've certainly linked the two. We did not need a tax cut right, at this point in the cycle. But if you look at the tax cut as an injection of growth prior to doing something restrictive like tariffs, and you link the two together, the strategy makes sense. We have more than enough room to actually saber rattle on tariffs because we've injected growth into the economy ahead of time. So here we have the Fed sort of adjusting to that new reality. Maybe we could have a slowdown in top line growth as a result of trade, but the Fed's going to stand there and say, hey, we've got room to cut to make sure that the expansion continues. Okay.